Learned a valuable lesson here. I'm not really sure what that lesson is, but I guess I learned something. Oh yeah, hedge your speculative positions and never trust CEOs and CFOs. Got it. Hey everybody, Walrus here from Walrus Street, bringing you your news and earnings for the week of December 6th, 2021. Just a reminder, I am not a financial professional. All information in this video is for entertainment purposes only. 2 weeks back to back, bloody red markets. What a horrible time to be sitting heavy equities and not have cash inside. Thankfully, as you guys know, since September, I've actually been sitting on a larger cash position than at any time in the last 2 years because this is the kind of thing that I was expecting, but I'm actually expecting even more of a dip, so I haven't really entered any of my cash position yet. A couple of updates before we get into the news. Today's video is going to be a little bit shorter because I am going to Yoido this weekend. I'm going to be filming another interview. Well, not really filming. I'm going to be on live TV again on MTN Money Today News here in Korea. That's kind of like the Korean Bloomberg channel. So I'll be sharing out that link when it gets posted, when it becomes available to me on Monday morning. So you guys could check it out if you want. The interview will be in English, so it's not like, you know, you're gonna have to be able to read Korean or understand Korean or anything like that, so don't even worry about it. One other quick update, I am going to be traveling to America to visit my family for the first time since before COVID for Christmas, so I might actually miss a week or two of videos. I'll let you guys know more definitive details as we get closer. If I end up getting quarantined for a long time when I come back because of the Omicron variant, well then, I'm really not gonna miss too many videos and I'll actually put out extra content. We'll see. Let's get into the news. Now, there were 3 pretty big catalysts to the downside this week. The first one, Fed Chairman Jerome Powell warns Congress that inflation may keep rising next year. Raise your hands if you're surprised about that. Nobody? Nobody in the class is surprised? Me neither. Powell warned Congress that while the Fed continues to expect that inflation will move down significantly over the next year, it now appears that factors pushing inflation upward will linger well into the year. The recent rise in COVID-19 cases and the emergence of the Omicron variant pose downside risk to employment and economic activity and increased uncertainty for inflation. Powell did acknowledge that the economy is continuing to strengthen and conditions in the labor market are still improving, but he also reminded senators that over the summer, the Delta variant slowed the economic recovery and intensified supply chain disruptions. Pandemic-related supply and demand imbalances have contributed to notable price increases in some areas. Supply chain problems have made it difficult for producers to meet strong demand, particularly for goods. Increases in energy prices and rents are also pushing inflation upward. Well, that's the long and the short of it. Nobody's really surprised by Powell's remarks here, but I do want to kind of highlight one thing that he said. It wasn't so much that Omicron variant is going to push the market down, it's more so he highlighted the word uncertainty. And if there's one thing the stock market hates, it's uncertainty. If you're in a strong bullish market, you can invest accordingly. If you're in a strong bearish market, you can invest accordingly. If you're in this kangaroo market that we've been in since like September, where September was down, October was up, November was flat, December started down, I mean, it's really hard to plan an investment path because there isn't a monodirectional trend to the market. It's more so just, yeah, kangaroo bouncing up and down. So the market hates uncertainty, and we had a lot of that this week. The next news story, U.S. government bond yields slide after jobs data. The job data wasn't great. Well, it was actually confusing more than anything. We'll get to that in a moment. But first, the yield on the benchmark 10-year Treasury note finished Friday's session at 1.34%. That is down from 1.44% at Thursday's close, and it's the lowest closing yield since September 22nd, and we remember what a disaster of a month September was. Yields, which fall when bond prices rise, swung between advances and declines after data Friday showed that employers added a seasonally adjusted 210,000 jobs in November. That fell short of the 573,000 added jobs estimated by economists. At the same time, the U.S. unemployment rate fell to 4.2% in November, lower than economists' expectations. The market read past the initial headline number, realized some of the details were okay. The 10-year yield, which typically moves with investors' expectations for growth and inflation, dropped in recent sessions after the emergence of the Omicron variant raised concerns of a slowdown in the recovery. That added to worries that high inflation could persist through a period of slowing growth. That jobs data was super weird, wasn't it? And of course, you guys know the media, everything has to be sensationalized. So the jobs data that was reported in the headline that everybody immediately saw was that 210,000 jobs were added compared to the 573,000 expected, which makes it sound absolutely catastrophic. And I don't think that any of the media outlets reported the fact that unemployment was at its lowest percent in years at 4.2%. So the jobs data, that's what I mean. It's really mixed. It's hard to understand how we're adding fewer and fewer new jobs, and yet the unemployment rate is so low. And one of my viewers, I can't remember who it was, maybe it was David last week, said something about the fact that early retirement is up. And I actually looked into this, and early retirement doesn't factor into the unemployment figures, and it doesn't factor into any of the employment figures, actually. Just once somebody's retired, they kind of remove themselves from the labor pool, and that's that. So I'm wondering if the early retirements that were brought about by the COVID pandemic and people just saying, I'm not going to go back to work, screw it, I'll retire 2 years early. I wonder if that's really messing with these numbers and complicating the situation a lot. The next news story, and obviously this is kind of the big one going back into Omicron, JP Morgan came out and said the Omicron panic is overdone by the dips in these stocks. What a weird random picture here. I'm not sure what this is pushing. Is it Santa and the Christmas season looking ahead? The JP Morgan strategist said over the last several days, markets have been in turmoil over the new COVID variant Omicron. However, data on Omicron is sparse, information contradictory, and some media have been exaggerating risks and highlighting worst case scenarios. No way. The media exaggerates risk and highlights worst case scenarios? Never would have guessed. The strategist went on to point fingers at a media blitz on Thanksgiving evening. If you remember, Black Friday, the market pulled back by 2 to 2.5%, depending on the index you were looking at. One of the lowest market liquidity points in the year, and that sent growth-sensitive assets crashing. The strategist took issue with a sell-off sparked by Moderna's CEO, who dashed hopes that current vaccines will work against Omicron, and they argued that his comments have been invalidated by reports from Pfizer, Oxford, the World Health Organization, and the Israeli Health Ministry. Early reports suggest that it might be less deadly, and if confirmed in the coming weeks, that could turn Omicron into a positive for markets. The possibility that a less severe and more contagious variant may crowd out the more severe variants, potentially speeding up the end of the pandemic and turning it into more of a seasonal flu, and that's amid vaccines and a growing list of treatments to tackle COVID. If the market were to anticipate that scenario, Omicron could be a catalyst for steepening, not flattening the yield curve, rotation from growth to value, sell-off in COVID and lockdown beneficiaries, and rally in reopening themes. Now, up to this point in the article, everything sounds perfectly reasonable. The JP Morgan analysts are saying the media is overblowing everything. This is in line with data from the World Health Organization that we've already seen about the severity of the virus in the preliminary stages. And I was with them on the article until I saw the stocks that they were suggesting buying right now. The first one, Apple. Okay, yeah, Apple is always a good buy. I think anytime somebody wants to put money into Apple, yeah, that's a good idea. That's a great idea. You know, depending on the day and where Microsoft is at, it's either the largest or second largest company in the world. So yes, Apple, great. GlaxoSmithKline, they're pushing this one for an antibody treatment that's effective against the Omicron variant. Okay, that's fine. But again, if the Omicron variant isn't so serious, then I don't really think this antibody treatment is going to necessarily be useful or it's going to drive price action. So I was a little bit skeptical about this one because it contradicts what they were saying earlier in the article. And then they completely lost me here. WeWork shares are down after the co-working space group said it will restate financials and admitted a material weakness. Oh, okay. So this is kind of like JP Morgan was playing two truths and a lie here. They gave us a decent idea with Apple, a decent-ish idea with GlaxoSmithKline, and they're like, oh yeah, by the way, these two good companies and WeWork. Yeah, just invest in WeWork. Just forget that the CEO for so many years was a complete crackpot and left the company in economic shambles, and the pandemic went ahead and magnified every single glaring problem with the company. Solid investment. This last one seems to me like JP Morgan is trying to unload their WeWork bags on unsuspecting readers. That's a funny one. Now into some more conventional news this week. Jack Dorsey is going to be stepping down as the Twitter CEO. Dorsey co-founded Twitter in 2006, forced out by the board in 2008, returned to the position in 2015, and Parag Agrawal, the company's CTO, is going to be replacing Dorsey. Fun fact, Agrawal is going to be the youngest CEO in the S&P 500 at 37 years old, barely beating out Mark Zuckerberg. Pretty solid stuff for a dude that started out at the company as an engineer. Awesome job, dude. Couple of statements. Jack went ahead and tweeted out that I love Twitter, but this is the funny part. Twitter stock jumped more than 10% following the news of Dorsey's resignation, prompting a suspension in trading. That's right, trading halted on Twitter after this announcement. If we go to the Twitter stock charts, we could see it's been in a pretty sharp decline since end of October. A lot of the tech stocks have been getting hit. Twitter's no exception. We're down to about $42 a share, but this huge candle right here, there was a midday spike that drove the price up like 10%. The day only ended up finishing up about a net 1%. But this huge candle right here, this was right after the news of Jack Dorsey's resignation. That has to be a shot to the ego. It really does. The same thing happened at Intel when the last CEO stepped down last spring. I forget the number, but we ended up seeing a huge rise in share price in Intel the day the CEO made his announcement that he was stepping down. I am obviously not the leader of a huge multinational company, but I feel like if I stepped down from a leadership position and then the stock price rose, that's a big oof. Oof size large. That's something that I would not quickly recover from. That is some serious damage right there to the psyche. In other Jack Dorsey related news this week, Square stock is going to be changing its name to Block. Dorsey and Facebook CEO Mark Zuckerberg apparently think alike. Dorsey Square will change its name to Block, the company said Wednesday, joining Facebook in a corporate rebranding. Square said the name change to Block reflects the company's commitment to blockchain technology, which underpins the cryptocurrency Bitcoin. The name change is effective December 10th. Unlike Facebook, the company's ticker will not change, and it will remain SQ. I went over to the Block website and I wanted to see what they have to offer. First off, I kind of like the fonts. It seems very computery, very techy. I like the coloration. Everything looks really cool. I went over to the governance and I wanted to see their leadership. I wanted to see if Dorsey had the beard picture up. And then I saw the most frightening thing I've seen in a long time on an actual professional website. Square is an $83 billion company, and this is what they decided to put on their website to represent their leadership. Please, cover your children's eyes. This content may be shocking to younger viewers. Leadership. What the f- Who thought this was a good idea? Who took, oh my gosh, who took like the PNG files and just stretched them over a cube? Oh, he doesn't have the beard in this picture. Oh my gosh, this is so terrible. I can't believe this is an $83 billion company. Who thought this was a good idea? I understand that the company is changing its name to Block, but this is a little on the nose. This is completely unnecessary. Why can't they just have their face on like one side of the block and then like some off-brand color on the other sides? What is happening? This is fantastic. Well, let's take a look at the Square charts. It's not been pretty. We ended up hitting a high of 270 at the end of October. This is around the same time Twitter and the other tech stocks started pulling back. And since then, it's just been, it's been a pretty sharp decline, sitting at about 181 after hours. Next news story. This is a crisis now, as if it wasn't before. Biden officials plead with Congress to immediately address the computer chip shortage. The worldwide computer chip shortage is fanning the flames of inflation and limiting the supply of everything from iPhones to new cars. Unfortunately, this highly disruptive shortage is unlikely to go away until deep into 2022. Hopefully by this time next year, or maybe a little before, the short-term crunch will be better. The long-term issue will take years to sort out. We just don't make enough chips in America. And there's the crux. We are imploring Congress to pass the CHIPS Act. It has to happen by Christmas. I'm not really sure why Christmas. This cannot take months. Funding for the legislation passed the U.S. Senate in June, but it hasn't been voted on in the House yet. The problem is that even if the funding does get through Congress, it'll take years to build and fully scale up new computer chip factories. And we actually have new computer chip factories cleared to be built in the United States. Intel is working on its foundry. Samsung is putting one up in the United States. I think TSM also has a facility building in the United States. So there are already facilities being built in the United States. And I wonder if that's one of the things that's causing Congress to delay voting on the CHIPS funding, because there are already outside external investors in Samsung and TSM that are investing to build foundries in the United States. And Intel is putting $20 billion of their own money into their own foundry. So that's the only thing I could think of. Congress doesn't really feel as pressured to get this funding authorized, but I don't know. I don't pretend to understand Congress. The FTC sues to block Nvidia's $40 billion acquisition acquisition of ARM. The U.S. action is the biggest hurdle the transaction has faced yet and threatens whether the deal will be completed. The problem here is that ARM's role in the chip industry was historically as a neutral supplier, raising concerns that Nvidia could cut off competitors from essential ARM technology. And that's where the monopolistic practices thing comes in. The proposed vertical deal would give one of the largest chip companies control over the computing technology and designs that rival firms rely on to develop their own competing chips. ARM is a core supplier of architecture technology to most semiconductor companies. Its ARM instruction set is at the core of nearly all mobile processors powering smartphones, including those made by Apple and Android devices that use Qualcomm chips. This is the complicated issue with antitrust and monopoly. Sometimes it's not necessarily a company taking over a competitor like we saw with Facebook and Instagram. Sometimes it's more so a vertical issue where a company takes over a supplier and then another supplier and a distributor. And suddenly the company can outcompete its competitors because they can control the prices on the supplier that everybody uses. And that's the fear with Nvidia here. And we've seen how semiconductors have been in the news so much lately because of the shortage. So people are almost a little more sensitive. Lawmakers are more sensitive to the antitrust situation here because can we really deal with a shortage? Can we deal with the bulk of the production being outside of America right now? And can we deal with the fact that Nvidia would be controlling ARM, which is providing the architecture for most smartphone chips? I really think that this acquisition between Nvidia and ARM is actually going to get knocked down and blocked, and I think that they won't be allowed to proceed, mostly because of the wider issues surrounding semiconductors right now. Next news story, China's DiDi is going to be delisting from New York and switching to Hong Kong. The company, which has been hit by increased regulatory scrutiny in China, wrote on its official Weibo account on Friday that it would begin the process of delisting and preparing to go public in Hong Kong. DiDi said in a separate statement its board had authorized the delisting in New York of its American depository shares while ensuring that ADSs will be convertible into freely tradable shares of the company on another internationally recognized stock exchange. DiDi launched its $4.4 billion New York IPO in June, making it the biggest listing by a Chinese company in the US since Alibaba in 2014. Days later, Chinese regulators ordered the DiDi app to be taken off domestic app stores. The company was also banned from signing up new users and subjected to wide-ranging government investigation into its cybersecurity practices. If we take a look at DiDi's chart since IPO, this is really one of the ugliest things that I've seen in a long time. And yes, I did look in the mirror today. We reached a high point of $18 the day of IPO, and it's just been loss after loss after loss since then. This is a gap down on the Chinese regulatory ban. This is a gap down on the repeal. And then we were just kind of trading in a channel here between 7 and 10. Just now, here's the delisting, and we're all the way down to $6 a share. Now, I had somebody tweet me about the DiDi situation on Twitter, and they asked me, oh, DiDi is down to $6. Is this a buying opportunity? No, my dude. No, this is like end of the road. This is like seeing a sign that says tracks out ahead or a bridge that's blocked off after a collapse. This is it. This is over. I don't want to share that tweet because I don't want to bring attention to that poor guy. I really think he just has no idea. Oh man, no, please don't buy DiDi right now. I don't tell you guys what to do ever, but please don't buy DiDi right now. Now this was, I think, the most interesting earnings report situation of the week. DocuSign stock plunges as billings, revenue guidance, miss expectations. And usually when I do this, I read the article first and then I look at the stock chart. But here, I want to look at the stock chart first so you guys can actually see this impact here. The day before earnings, December 2nd, DocuSign closed at $233. The next day, it dropped 41%, closing at $138.73, and it proceeded to fall off even more throughout the week. So when you look at a gap down of 41% on a company that's worth tens of billions of dollars, your initial expectation is that, oh my God, the earnings report must have been complete shit. They must have just crapped the bed, smeared it all over the walls, and lit the whole place on fire, right? I mean, that was my take on it. That was my initial thought when I saw this chart as it was happening. That's not the case, though. Billings, a sales growth metric, in the third quarter rose 28% to $565 million. That fell short of estimates of $594 million. Okay, yes, this is negative, but still, this is 28% growth in the third quarter, going up to $565 million, and just barely coming short of $594 million. That doesn't doesn't seem enough to me to warrant a 41% drop. Earnings came in at 58 cents a share. Revenue rose 42% to $545 million. A year ago, earnings were 22 cents a share on sales of $383 million. So this is amazing growth year on year in both the EPS and the revenue. And analysts that follow DocuSign expected the company to report earnings of 46 cents a share and sales of $532 million. Analyst expectations, these are the guys that actually cover the company, expected 46 cents a share. The company reported 58 cents, which is a 25% plus beat. They expected $532 million in revenue. Company reported $545 million, which is a beat. And the company's forecast for the next quarter is a further increase up to $560 million. But the analysts have projected revenue of $575 million. Okay, so we have beats on revenue and EPS. Forecasted guidance for the next quarter coming in about 2%, just 2% less than what the original forecast guidance was. And the share price drops off 41%. What? I'm sorry, what? You beat EPS, you beat revenue, forward guidance is only down by 2%, and the share price drops 41%? The only thing I could think is that the market has become so overvalued that current earnings just don't matter anymore, and all that matters is future guidance. And I think I made this comment a couple weeks back when I looked at Rivian. How far in the future are we valuing these companies? And maybe this DocuSign is more evidence of that. Apparently, the company was so overvalued that just lowering their next quarter revenue projections by 2% causes a 41% share price drop. Wow. I would hate to be the person inside on that company that was putting together that earnings report, because I would have been totally blindsided if I was them. I would have reported the earnings call, looked at the stock chart and been like, what? Did you guys hear the same report that we just gave? Because the one that we gave was pretty damn good. Oh boy. Next news story, I have to do it. Why Kirkland's shares are getting clocked today. Well guys, boy was I wrong on Kirkland's. I went back and I looked at their last earnings report and all the information that I pulled, and there was nothing in that to lead me to believe that this was going to happen. Nothing at all. On the last earnings report, the company was talking about how they were taking all of these preventative measures to make sure that the supply chain disruptions were not going to be affecting them. They were increasing their gross margin. Everything was looking great. There were no clues, zero clues whatsoever that this was going to happen. And yet it happened. I don't know what to say, guys. Sometimes this happens in investing. All I can say is that I'm so happy I structured my trade for Kirkland's the way I did. The way that I structured my trade in that video, if you remember, I went in for like 200 shares. I bought 2 at the money calls for March, and I bought 2 at the money puts for March. The morning of this earnings report, my stop loss triggered and my shares sold, and then I went ahead and manually sold the puts, and the puts had been picking up steam because of all the market drops for the previous week. So my puts, when I sold them, I actually ended up about $50 ahead when I sold the shares and closed out my puts because of the IV spike, because of the huge price movement, the downward action. So I have my calls open, but with the $50 that I made from selling the shares and closing out the put position, even if my call position goes to zero, I'm only going to be out $200 on this one. So on one hand, I'm really sad that my read on the situation was wrong, but on the other hand, there were no clues that the situation was going to be this bad given by management. I did the best that I could with the information that I had. I employed proper risk management. I'm only out a couple $100, which that's nothing. I can afford to lose that. I guess, live to fight another day. Learned a valuable lesson here. I'm not really sure what that lesson is, but I guess I learned something. Oh yeah, hedge your speculative positions and never trust CEOs and CFOs. Got it. The CEO said, looking at our results through the end of November, we were impacted by inconsistent traffic patterns and broader supply chain constraints. During Black Friday, we saw in-store traffic remain relatively flat on a year-over-year basis, but there was a meaningful decline in e-commerce traffic, which led to a total sales comp decline for the first month of the fiscal fourth quarter. Let's take a look at the upcoming earnings. There's a few interesting ones. Obviously, the one that's going to jump out at everybody is going to be GameStop. Can't stop, won't stop. GameStop is going to be reporting on Wednesday after close. Everybody's going to be paying attention to that one. one. Ryan Cohen's other company, Chewy's, reporting on Thursday, along with Lululemon and Costco, a couple of really hot brands. We have a lot of outdoor sporting goods type stores, Sportsman's Warehouse, American Outdoor Brands, Academy Sports Outdoors, all reporting in one big group Wednesday, Thursday, Friday. There's a couple of charts that I do want to take a look at very quickly, just to kind of go through some statuses for these companies. I want to look at Photronics and Udemy. Photronics is another one. I always forget what this company does. It's a manufacturer of photomasks, which are used in the manufacture of integrated circuits and flat panel displays. Okay, don't know any of those words. Sounds like something tech related, cool. The chart's really, really healthy though. It's been in a uptrend, and it's got a lot of healthy higher highs, higher lows. This is the kind of stuff that you like to see. And despite the broader market pullback, Photronics here hasn't really been affected by it. And it doesn't seem super overvalued for a tech company. The PE is at 20, price to sales is 1.47, price to book is 1. Honestly, this Photronics company looks really, really healthy. Market cap of 841 million, so this would definitely be considered a small cap. And if we go over to the income statement, revenue steadily increasing. It's not like a shocking increase, but it's a steady increase. 149, 152, 59, 70. Net income increasing even more, 8 to 9 to 16 to 24. And actually, if we go back just to the 1-year chart, you could better see this channel that I'm talking about. Look at this healthy rise. Like, you don't see any artificial gaps up. Like, this is just a nice rising channel the entire year. I really like the way the chart looks. I like the financials of Photronics. On the opposite end of the spectrum is Udemy. This is a company that IPO'd at the end of October, and it's a online e-learning provider type thing where content creators put out courses. Their market cap is about 3 billion. If we go over to their financials, their revenue, 126 million, 124, 110, 118. Net income, yeah, they're losing money, but they're pretty close to break even. So this is another one where it's just, why? Why is it valued so high? I don't know. So this is another one that I do think that it has more to drop, but I guess that's totally dependent on earnings, and we've seen that earnings are almost impossible to forecast right now. That's it for me today. Hope you guys did enjoy the video. As always, if you want to support the channel, check out my Webull referral link below the video. If you sign up for an account, deposit $100, you get a free stock, I get a free stock, everybody wins. Also, if you enjoyed the video today, please be sure to like the video, subscribe to the channel, and if you want to be alerted to all my content as soon as it goes live, make sure you hit that notification bell. All right, everybody, thanks a lot. Stay safe. Good luck investing, and I'll see you next time.